What the bank is looking for when it lends money is to get that money back at some stage. And that's what we mean when we talk about viability. That's what we mean when we talk about sustainable businesses. If we lend you some money on a loan or on an overdraft, you have to prove to us that we're going to get that money back at some stage and within an agreed program. And we actually prefer to get the money back from you before you start making a lot of money out of your business. And that's fair. We've not got equity in your business. We're not stakeholders in your business. We're helping you getting going. And the margins that we ask for, the lending margins we ask for, are not equity returns. This is lending, traditional lending, and we like to get our money back before you make your million. So what the bank will look for is a decent cash flow forecast, which is realistic, which sensibly can see how repayments are going to come back, but ideally not seeing the directors making more money out of this before the banks are repaid. Many businesses will say for the first 2 years it's building stage, and after the first 2 years then we know whether this is going to be profitable and we can start making profits and taking some money out of it. And quite often a business will say when they speak to the bank, how often can I get a good salary out of this? When can I start drawing money out of it? And the answer really is when you're sure you're making it. Whenever people go into business, they tend to go in optimistically believing they're going to make a profit. And that's good. You need that enthusiasm, you need that certainty that you're going to survive in this. But in terms of financially taking money out of it, just make sure you have made that money before you take it out, because many businesses find their projections have been over-optimistic and they do have to pull back a little bit as the first year or so goes on. Too many people don't work out how much they're going to have next week and the week after and the week after. Too many businesses just go day by day by day. And it's so important to be able to plan forward and see where your cash is. And that's what the bank looks for. When we talk about the importance of a cash flow forecast, it really is to say, are you going to be able to afford your bills, afford your staff bills, afford your stock bills, afford the payments to creditors? Are you going to be able to afford those going forward? And how much money do you need in to be able to afford those? And all those areas are the important components. We just love anything you'll give us. So any information you'll give us will help us to understand what you're trying to achieve, will help us to do our sensitivity analysis, will help us to talk with you about whether we think you'll be successful. And we brought out a guide, which is a practical guide which goes through all the areas that we look at. And this we see as very important. Many businesses don't bring anything to us apart from an idea. And it's so important that we do have an idea from the business owner what the cash flow is going to look like, what the profitability will look like, how they're going to manage their debtors. All those areas are very important in us working with the business to see what the cash flow is like and what the profitability is like. And that's why we brought out a quite simple, practical guide to help businesses work through those forms and spreadsheets that we need. We will look for 3 specific areas of information. One will be the cash flow forecast, and that's so important because that says whether you're going to survive in terms of having enough cash available to meet your payments, to repay the bank loans, to pay your creditors, to pay your staff. So the cash flow forecast is the absolute critical piece of information we look at. Then secondly, we'll look for a profitability forecast. So you may be able to survive for several months having enough cash there, but actually if you're not making a profit over time, then you're not going to be able to sustain yourself and be viable long term. Then the third piece of information we'll look at will be your management information. So this will be your balance sheet, your month-to-month balance sheet, it'll be your debtor lists. So if we look at your debtor list, for instance, are you getting paid on time? Or are you giving 30 days to your debtors to pay in the first month and then that drifts to 45 days or 50 days or 60 days? That's when we know you've got problems. So we'll look at the cash flow forecast, we'll look at your profit and loss forecasts, and then we'll also look at the extra information around the debtors, your creditor lists, maybe your stock lists, your projected balance sheet, and some historic information. So if you've been going for several years, we'll look at one balance sheet against the previous balance sheet against the previous balance sheet and see where those trends lie in terms of debtors, stock, things like that. Well, I think the first thing you have to do is research the market. If you're starting up in a new area, in a new market, in a new location, then research your market. Most most people starting at businesses will have had some experience in the business that they're starting up, but they might not necessarily have had the experience in that location. They might not know whether there's competition in that area. So, research the area, talk to people in the same industry, not necessarily in the same location, but in the same sector. Talk to people and see what sort of volumes you can expect coming through, and plan your business on that basis. Now, having planned your business on the volumes you hope will come through, then sensitize that. Assume that you get 25% less, and assume you get 50% less, and find out where what we call your break-even is. So what level of your turnover you can live with and still pay your bills without making any profit. So where's your break-even? Now, I would say if you're still confident or very confident that you can hit those levels, then fine, start the business. But until you're sure that you can hit those levels of business above your break-even, then don't start investing heavily. So test the market. You can do some market research. You can actually test the market through pamphlets, through market research, through asking people. See what your market is. Really get in there rather than going in blindly, hoping that you'll get the volumes that'll make you your million. So if the business starting up has got a poor credit history itself, now that might be because it's had a business that's failed in the past. And actually, I would regard that as good experience. And the American model certainly says if you've had a business that's failed in the past, you've learned, and truly you have learned. In England, we're not quite so forgiving of businesses that have failed. We still say, well, they failed once, they're bound to fail again. Well, that's not necessarily the case. So we'll look at that with open eyes, but be transparent about it. So if you're going to come and talk to the bank and say, look, I had a business that failed, what I learned last time was this, and I've made sure that's not going to happen again because I've done this, that helps us. If you come to us and you've not told us at all about a failed business in the past, then when we do our credit searches, we find that actually you've been associated with a business that's failed, then that puts us under notice, and we become a little bit suspicious about whether you're going to fail or survive this time. So be open and honest with the bank is the best advice. But if you have got a bad credit history, it is difficult. You must be open and honest. What so often a business provides to us when we look at a business plan is all the background information on the product they're going to make, why they're going to make that product, and all those sort of things. And that's great stuff. That really is good stuff. What that doesn't tell us, though, is how you're going to repay your borrowing. And the thing that we at the bank are really looking for is how you can service your borrowing, and are you going to be profitable? So bringing a lovely book with all the designs of everything you're going to do, if you can't prove to me that you're going to repay a borrowing, then the pretty stuff actually is of limited value. So what we're really looking for is, yeah, sure, give me an idea, give us an idea of your passion, your commitment, and all those things which so many businesses bring. But also, most importantly, is how are you going to repay this? Where's your income going to come from? What are your costs? How do we sensitize those? What do you do if your sales don't come through? How low can your sales go before you maintain your break-even point? All of those things are the important things for us.